Ever wondered how businesses track their financial activities? Welcome to the world of accounting. This fascinating discipline, often referred to as the language of business, is a crucial element in the daily operations of companies worldwide. At its core, accounting is all about recording, summarizing, analyzing, and reporting financial transactions. It's like the heartbeat of a business, constantly monitoring and measuring its financial health. From the local coffee shop on your street corner to colossal multinational corporations, accounting ensures every penny is accounted for and every business decision is informed by financial insights. But it's not just for businesses. Accounting principles touch our lives in many ways, from managing personal finances to understanding the economy. It's a powerful tool, a lens through which we can view the financial world around us. Now that we've introduced what accounting is, it's time to delve deeper into specific accounting concepts. Imagine a world where for every action there's an equal and opposite reaction. Surprisingly, this isn't physics, it's the double entry system in accounting. In the world of accounting, every transaction has two sides, like a coin. This is the essence of the double entry system, a method that records both the debit and credit of each financial transaction. Let's break it down. The word debit might sound a bit scary, but it simply refers to the left side of a ledger. On the other hand, credit refers to the right side. In every transaction, the total debits must equal the total credits. This ensures that the accounting equation stays in balance, and it's the reason we call it the double entry system. So how does it work in practice? Let's say you start a business with $100,000. In the double entry system, you would debit your cash account because you've increased your assets. At the same time, you would credit your equity account, representing your investment in the business. This way, both sides of the transaction are recorded, keeping your books balanced. But it's not just about keeping things in balance. The double entry system also provides a clear trail of every transaction. This makes it easier to track what's happening in a business and to spot any potential issues. Now let's take it a step further. Suppose you make a sale of $10,000. You would debit your cash account again, increasing your assets. But this time, you would credit your revenue account, showing the income from your sale. Again, you've recorded both sides of the transaction, keeping everything in balance. In the end, the magic of the double entry system is in its simplicity and balance. It provides a clear, logical way to record transactions, making it easier to understand the financial health of a business. And that, in essence, is the double entry system, the backbone of accounting. Ever wondered how a company's financial health is measured? Say hello to financial statements. Financial statements are vital documents that provide a snapshot of a company's financial health. They're like the company's report card, and they've got three main components, namely the balance sheet, the income statement, and the cash flow statement. Let's start with the balance sheet. This is a statement of the assets, liabilities, and capital of a company at a particular point in time, detailing the balance of income and expenditure over the preceding period. You can think of it as a snapshot of what a company owns and owes. It's all about balance, hence the name. Next up, we have the income statement, also known as the profit and loss statement. This statement provides information about a company's revenue and expenses, resulting in a net income or net loss for a specific period. It's a dynamic document that shows how the company's revenues are transformed into the net income. Lastly, we have the cash flow statement. This statement shows how changes in balance sheet accounts and income affect cash and cash equivalents, and breaks the analysis down to operating, investing, and financing activities. In simple terms, it shows where a company's cash came from, where it went, and if it made or lost money. These three statements are interconnected. The bottom line of the income statement, the net income, is also the starting point for the cash flow statement. Meanwhile, the balance sheet reflects the company's financial position at the end of the fiscal period, which is influenced by the activities recorded in the income and cash flow statements. These financial statements are not just numbers and figures. They tell a story about a company's financial health and performance. They help investors, creditors, and management make informed decisions about the company's future. They help identify trends, measure performance, and predict future performance. So, financial statements are like a company's health report, giving us a clear picture of its financial standing. Now, let's talk about two major accounting methods: accrual accounting and cash accounting. Starting with accrual accounting, this method recognizes revenues and expenses when they are earned or incurred, regardless of when cash is exchanged. For instance, if you provide a service in December but don't receive payment until January, under accrual accounting, the revenue would be recorded in December when you earned it. This method gives a more accurate picture of a company's financial health as it includes receivables and payables. However, it can be more complex to manage and might not show the immediate cash flow situation. On the flip side, we have cash accounting. This method records transactions when cash is actually received or paid. So, in our earlier example, the revenue would be recorded in January when the cash is received. This method is simpler and gives a clear snapshot of how much cash a business has on hand. However, it can be misleading as it doesn't account for obligations or anticipated revenues. Now, which one to use? Well, small businesses or freelancers might prefer cash accounting for its simplicity and focus on cash flow. Larger businesses or those with complex transactions may opt for accrual accounting for its comprehensive financial insight. Remember, these two methods are not interchangeable within the same fiscal year. So, a company must choose wisely based on its size, complexity, and future growth plans. So whether a business chooses accrual or cash accounting depends on its specific needs and circumstances. We've covered a lot of ground today, haven't we? From the basics of accounting to the nuances of the double entry system, we've delved into the intricacies of financial statements and compared accrual and cash accounting. Each concept is a crucial cog in the machine of business finance, collectively forming the backbone of any successful enterprise. Accounting may seem complex, but with these concepts under your belt, you're well on your way to understanding the financial side of business. Until next time.